What if the next 10 years could unlock more wealth than the past 30? With AI booming, energy transforming, and global tech evolving, the right investments today could be the reason your portfolio outperforms the market by 2035. In this video, we're revealing 5 elite stocks across the US, UK, Canada, and Germany that smart investors are locking into now for serious long-term growth. Welcome to Evercrest Capital, where we bring you high-quality stock insights for building passive income and generational wealth. Today's picks aren't just trending, they're fundamentally strong, future-ready, and globally diversified. Whether you're in tech, dividends, or industrials, these companies are positioned to deliver over the next decade. Stocks name: 1. Microsoft Corporation, MSFT. 2. Siemens AG, SIGY. 3. Canadian National Railway, CNI. 4. Diageo plc, DGE.L. 5. Nvidia Corporation, NVDA. So without any delay, let's go. First is Microsoft Corporation, MSFT, USA. Matt in the intro, founded in 1975, Microsoft has evolved from a Windows software pioneer to a global leader in enterprise cloud, AI, and productivity solutions. Its diverse ecosystem includes Azure, Microsoft 365, LinkedIn, and strategic AI investments like OpenAI, which powers tools such as ChatGPT. Market cap: $3.41 trillion. Stock price: $458.76. Dividend yield: 0.72%. 3-year performance: plus 72.99%. Why it's a decade-long winner. Microsoft's growth story is anchored in cloud and AI. Azure now contributes over 30% of revenue and is growing at 28% YOY. Microsoft is integrating generative AI across Office 365 and Dynamics, making it essential for global business productivity. With enterprise clients locked in long-term, recurring revenue is robust and predictable. The company also benefits from its dominance in developer ecosystems and its expansion into gaming, with Xbox and the Activision Blizzard acquisition creating another monetization channel. Analyst sentiment and outlook: Wall Street unanimously ranks Microsoft as a strong buy. Its balance sheet is bulletproof, margins are consistent, and it's riding 2 unstoppable trends: AI and cloud. Analysts see potential for a 12 to 15% annual return over the next decade, powered by enterprise AI, global SaaS adoption, and shareholder-friendly capital returns. Bottom line: if you're looking for a core holding in your long-term portfolio, Microsoft checks every box: growth, resilience, and innovation. Second is Siemens AG, SIGY, Germany. Siemens is Germany's most iconic industrial conglomerate, now transforming itself into a leader in digital industries, smart infrastructure, and automation. With operations in over 190 countries, Siemens touches energy grids, manufacturing plants, rail networks, and more. Market cap: €168.34 billion. Stock price: €211.80. Dividend yield: 2.22%. 3-year performance: plus 57.33%. Why it's a decade-long winner. Siemens is undergoing strategic transformation. The company divested non-core operations and doubled down on industrial automation and digital twin technologies. Its flagship Accelerator platform integrates AI with hardware, enabling real-time factory analytics and predictive maintenance, key to smart manufacturing. With the EU investing heavily in reindustrialization and clean energy infrastructure, Siemens is a direct beneficiary. Its software and hardware combo gives a unique edge over pure SaaS or legacy industrial players. Analyst sentiment and outlook: European analysts rate Siemens as a moderate buy with an improving growth outlook. Its dividend is reliable and growing, appealing to conservative investors. With global infrastructure spending expected to reach $94 trillion by 2040, Siemens is ideally positioned. Bottom line: a perfect blend of technology and infrastructure, Siemens is a strategic long-term bet for investors looking to ride Europe's digital and energy transformation. Still with me? Great, because the next stock is an underrated powerhouse from Canada that dominates a century-old industry and still grows like a modern tech firm. You'll definitely want to hear this one if you're serious about long-term stability and income. If you found value in this video, don't forget to hit that like button. It tells the YouTube algorithm you want more content like this. Subscribe and turn on the bell notification so you never miss our next high conviction stock pick. Third is Canadian National Railway, CNI, Canada. Canadian National Railway, or CNI, is Canada's largest rail operator, responsible for transporting over 300 million tons of goods annually across North America. Its extensive network stretches from the Atlantic to the Pacific and down into the U.S. Gulf Coast. Market cap, $66.02 billion. Stock price, $105.01. Dividend yield, 2.45%. 3-year performance, minus 8.85%. Why it's a decade-long winner. CNI thrives on consistency and cash flow. With fuel costs rising and ESG mandates growing, rail freight is gaining preference over trucking for its energy efficiency. CNI is also investing heavily in AI-driven logistics, predictive maintenance, and automated rail yards, boosting its operational efficiency. The company is expanding its intermodal services, making it a vital link in U.S. Canada-Mexico trade. With a duopoly market structure in Canada, enjoys high pricing power and low competitive threats. Analyst sentiment and outlook. CNI is considered a blue-chip income stock by Canadian analysts. It's consistently profitable, shareholder-friendly, and positioned to benefit from North American supply chain reshoring. Analysts expect moderate capital appreciation with growing dividends, making it ideal for conservative long-term investors. Bottom line, CNI isn't flashy, but it's dependable for long-term income and stability. It's a backbone stock with 100-plus years of momentum behind it. Fourth is Diageo plc, DGE.L, UK. Diageo is one of the world's largest beverage alcohol companies, owning global brands like Johnnie Walker, Guinness, Smirnoff, and Tanqueray. It dominates the premium spirits market and has a major presence in both developed and emerging economies. Market cap, £45.3 billion sterling. Stock, £2,026. Dividend yield, 3.78%. 3-year performance, minus 45.66%. Why it's a decade-long winner. Diageo's strength lies in its pricing power and brand loyalty. As consumers shift toward premium experiences, Diageo has expanded its high-margin labels and direct-to-consumer channels. It's also adopting data-driven marketing and AI to enhance customer engagement and supply chain efficiency. With strong operations across Africa, Asia, and Latin America, it's a perfect hedge against Western market saturation. Its resilience during economic downturns adds an extra layer of defense. Analyst sentiment and outlook. UK analysts see Diageo as a defensive long-term hold. Its dividend has grown consistently, and earnings are expected to rise in the mid-single digits annually. With durable cash flow and wide global moats, it's a favorite among retirement investors. Bottom line, Diageo offers quality, consistency, and exposure to global consumer trends, a true compounder in any long-term portfolio. And the last stock is Nvidia Corporation, NVDA, USA. Nvidia has transformed from a graphics card company into the undisputed king of AI and data center computing. Its GPUs power everything from autonomous vehicles to AI models like ChatGPT, and is at the center of the fourth industrial revolution. Market cap, $3.29 trillion. Stock price, $134.73. Dividend yield, 0.03%. 3-year performance, plus 374.1%. Why it's a decade-long winner. Nvidia's innovation pipeline is unmatched. Its GPUs dominate AI training workloads globally, and its new Grace Hopper superchips are designed for hyperscale data centers. The company is also breaking into automotive AI, robotics, and 3D simulation with its Omniverse platform. Revenue from data center AI now exceeds gaming, and growth is accelerating with major cloud providers doubling down on NVIDIA architecture. Analyst sentiment and outlook. Analysts across the board rate NVIDIA as a strong buy. While valuation is rich, growth justifies a premium. With AI becoming foundational across industries, NVIDIA is positioned like Intel in the 1990s, but with faster scalability. Bottom line, If you want exposure to the fastest-growing tech trend of our generation, Nvidia is non-negotiable in a future-focused portfolio. So, let's quickly recap the 5 powerhouse stocks we covered today. 1. Microsoft, the AI and enterprise cloud titan from the U.S. 2. Siemens, Germany's leader in digital infrastructure. 3. Canadian National Railway, Canada's freight backbone with stable income. 4. Diageo, the UK's global beverage giant with premium pricing power. 5. Nvidia, the rocket fuel behind the AI revolution. These aren't just strong today. They're built to thrive for the next decade, even as markets evolve. From AI breakthroughs to infrastructure megatrends and global trade routes, these companies are positioned at the center of it all. If you're building a long-term portfolio that balances growth, stability, and future potential, these 5 stocks deserve a spot on your radar. Like this video if it helped you discover a new stock. Subscribe for weekly dividend and growth stock picks. Drop a comment below and tell me, which one of these 5 are you buying first? And don't forget, there's a playlist at the end. If you're building long-term wealth through passive income, that playlist is your next stop. Thanks for watching. I'll see you in the next one.